Good morning. Sorry I'm late. Let's wait a little bit for some more people. You can write in the chat. So how did your statistics review go? I really hope you got through it because I'm going to use what was in the review. I condensed what you needed to know from your statistics classes to that which will be relevant for the course. Did you get to this document? Did you review this document? So this is the kind of thing we're going to look at in this next unit. Here you have two sets of financial data. You have information on the S&P 500, which is an index that captures market performance of the 500 top performing stocks at any given time. And it combines them by their valuation or their capitalization in the market. It weighs them into an index. And at this point in time, period 1, the S&P 500 has a return of 15%. So anyone invested in the index, which you can do, will have observed a return in period 1 of 15% for every dollar. So for each dollar invested, that's 15 cents. But people invest more than a dollar. And then there's this company here, Bell Canada Enterprises, that has experienced 30% return for its investors. So stockholders in BCE over this period have earned 30 cents on the dollar. All right, so this is the kind of data we're going to work with. We're going to go further today and talk about where these numbers come from. But for now, what do you see here? So if you saw this already, fine. For those who didn't, can you identify yourselves if you haven't seen this yet? Because it depends, it'll affect how fast I go. How is the sound right now? Does the sound good? I learned about a new software to help cancel the surrounding sound, so I'm going to set it up for next class. Okay. All right, so nice of Beth did watch this. All right, so this is where we're going with this. So looking at this, what is the relationship? Is there a relationship between the variables? What is the relationship between the variables? Well, if you saw it, then you must know the answer. Right, so it looks like the returns to this stock are 2 times that of the returns to the index. Okay, so it means that, or the way that we interpret this is that BC returns are sensitive to market performance. All right, so what we do is we display. So I've already chosen how I'm going to depict these in a coordinate axis, and what I do is I always put the market on this axis, and that implies that the market influences BC returns. Okay, so that's certain that market is going to influence the market. You know, that economic circumstances are going to influence the returns to stock. So you always put the stock here. And then you plot them. And when you plot these, you're going to see, if you haven't already, that it's going to go like this. And they are going to appear on a line. Now that's not always the case, okay, but I've made them so they're perfectly on a line. But that's not necessarily the case. What's more likely is that they'll be scattered. Returns will look more like a little more uncertainty, and that's really why we have to go beyond what we learn in high school about lines to dealing with a scatter of data. and introduce statistics for estimating a prediction line out of that scatter. But in this case, I put them perfectly on a line for you, and then I asked you to calculate all these stats here. So we begin with the average, which we know, right? So this is just add them up and divide by how many. This is the sample standard deviation, because this is really a sample. So that's the sample standard deviation. And then this one is, okay, so the standard deviation is a square root of the variance. The covariance looks like the variance, but rather than taking the deviations from the mean and squaring it, because that's what the standard deviation is, it's a measure of how spread out the data are. The larger the standard deviation, the more spread out, more variable. And I explain in the videos where this formula comes from. And then at this point, we can talk about covariance, how the deviations from the mean in either direction are related. And as when one goes in one direction, what does the other one do? So how do they trend? And then from there, so covariance is a number depending on the variation in the variables and the magnitude of those variables, like how high the numbers are. From sets of variables, from pairs of data to pairs of data, covariance is a different number. So to make it a little more streamlined, what we learned to do is to standardize the covariance. You do that by dividing out the variability and reducing the covariance to an index. This thing is called the correlation coefficient, or some people just say correlation, and correlation is always between -1 and 1, and we know what that means better than any measure of covariance. And in our case, our relationship is let me write it out here. This is like a review, but just in case, this is really important that you get this. R is a measure of direction and strength of a linear relationship between two quantitative variables. And that's why we like it, and we use it and variations of it in finance, because we're dealing with quantitative variables. So direction is seen in the sign, and the strength, how strong that relationship is seen in the magnitude. So it's a stronger linear relationship if it's close to 1 or -1. So what do we call this relationship? We expect the R here to be positive, because this is a positive relationship. It means that when when X improves, Y improves. So if I leave the line, the supposed line that fills the gaps here, so if we did have to make a prediction, we could use that line for values that aren't there. For this value of X, I could predict what Y would be. That's the idea. And it looks like when I leave the line in this direction, positive, I have to return to the line going positive on the y. So that is a positive relationship. And in this case, it's perfect. It's strong. We say r is equal to positive 1. We use the line to estimate around the data. We don't go outside of it. Okay, so it's not like a mathematical line. A statistical line is contained or limited by the range of values of x and y in your data set. If you try and estimate outside the line, that is known as extrapolation, and it's frowned upon if it's way too far out. It's more acceptable if the data are very close to the line, or you have a stronger R. It's more acceptable to say, you know, we could go a little further out to make estimates, but never too far out, because relationships change. So looking at that, looking at this other more general data set here, what would you say the R is for this data? So it's going to be a positive because of the trend. What value would you give it if you had the data and you punched it in? What would you expect? Yeah. Marcel says 0.8. Maybe a little less strong, but thank you for the guess. Maybe like 7.5. Or 7. Okay. I'll say 7.5 because 6 is even more scattered. Okay, so that's good. All right, so R can be calculated as the standardized covariance. It could also be calculated this way, where if I was to use to do this manually, I could calculate the deviations from the mean, standardize, and then average them. This is a measure of average. And then the other way to write this is this way. So this expresses standardization. I'm standardizing the two variables and finding the standard deviations from the mean, and that is really essentially what converts it into an index, that I'm standardizing each value in the pair and then multiplying and averaging those. All right, and that brings us to what in the world is B. B is a measure of the slope. The slope you see here actually depends on R, and then a ratio of the two standard deviations. And I explain that a way to remember that relationship, yeah, I'm just looking at the comments. The way to remember that relationship is use the word risk as a mnemonic. So it's R, then SY, the Y first, divided by SX. And what does that give you? Well, B will have the same slope as R, right? Because these are both standard deviations, they have to be a positive. And B will have to have the same the same sign as R. So they'll have the same sign, but there'll be different values. And I call it risk, not by coincidence, not just because of the mnemonic, but what it represents. B gives you an idea of how sensitive returns for the company. So Y, we always write them in a certain way. So the returns on the stock relative to the market. So the higher the B, the more sensitive, which it looks great when things are doing well, but what about when the market does poorly? What if, and I just said we're not supposed to extrapolate, but let's say we had more data, and then let's say there was more data and turns out the market dips. So there are 2% negative returns in some period in the future. What would be the returns to BCE? If the line did continue. I'm supposed to go through the origin with my data. So this line, the coordinate axis goes into the negatives. You can have negative returns. So BCE returns would be not just 4%, but negative 4%, because it's double. So you see, that's not a good thing. So that's what makes it risky. It looks good, and it's good in the good times, but if it continues, it's also sensitive the same way in the bad times. It's risky. Very good. Good. All right, so my next question to you is, what is the slope so this is going to be the slope. B is the slope of that prediction line of the data. So what is the slope for X and Y in this case, BCE and the market returns? So I haven't even made a calculation, and I know all these things just by drawing. So it's very important to make a scatter plot, right? You also need to know how to make these calculations, but by making a scatter plot, you can see a lot. And in computers, you could do that very easily. Manually, with a few numbers, you can do it. Okay, so then the slope, that's where the 2 comes in, right? So that's the 2. So it means that if I move away from the x-axis, for every unit I move away, I can return back to the line in the y direction by 2 times the units of x. Okay, so for each unit change in x, I have to go 2 in the y direction to get up. So if I moved 10, I would have to go 20 up. Or if I moved -5, I would have to go negative 10 up. Those are all in the same ratio. Or negative 10 down, sorry, to get back on the line, right? So if I'm here and I move negative 5 to get back on the line, I have to move down negative 10. All right, so I'm going to ask you now for this one, what would the B, what would the B as a slope be? Could it also be 2? So the slope is the line, the line is that which fits closest to all of the data, and it's the result of minimizing the squared residuals, and it puts you right in there. So B could be 2 here as well, because I want to be closest to all the points. It could be. But the main difference between this scatter with B and this scatter with B of 2 is that this is much more unreliable, right? Because these are all scattered about. And that's most likely what you're going to see. This is perfect and reliable. You can feel pretty safe that if you use this prediction line, you're probably getting a great estimate if you use it to make predictions. I'll put a few more dots if it's bothering you. I'll put a few more to make it look there. Or like 2. All right. So the last thing is to punch this in your calculator together. And I don't know if you got to that part of the video, but it's really important to be comfortable with doing that. So we go to the calculator, we clear it, and we start to enter data in stat mode of the calculator. So I did that by second data. Now there's something in there, I need to clear it out. Second clear work. So once I'm in the sheet, the worksheet, I can clear it. And I enter the data as 15, enter down, and now the pair, 9, enter down. Now the second pair, no, that's not right. Not 9, it was 30, enter down. The X, the next one is 9, enter down, and 18, enter down its pair. Next pair is 10, enter down, and 20, enter down. The next one, 7.5, enter down, 15, enter down. And lastly, 8, enter down, and 16, enter down. That's my data. So I'm going to confirm the values that I got using my calculator. 15, 30, 9, 18. I messed it up. 15, 30, 9, double 18, 10, double 20, 7.5, double 15, 8, double 16. There's my data, and now I hit the results, second stat, and I get the linear results of n equals 5, x bar is 9.9. This is the sample standard deviation is 3. this is the population standard deviation, which is 2.69. Now that is as if I was interested in the if I considered the data representative or not, sorry, if I considered the data as complete, or the population level data, which it is not, it's just a sample. In this case, I would have divided by n rather than -1, and that would be the result. A little bit smaller because we're dividing by a bigger number. So we don't use that one, we use this one if we need it. And then the next variable, 19.8, is its mean, its standard deviation for the sample. And then these are the values for the line. This is the y-intercept, this is the slope, and this is r. All right, so as intense as all those formulas seem, which you do need to know them, you can easily get these results out of your calculator. Questions? No questions? Okay. So then that is for data that are ex post or historical. So looking back, these are the data. These are the formulas for the statistics, computing the statistics for historical data sample, or sample of historical data. But what if your data appear like this? This is known as ex ante data, so after the fact. Before the fact data. Ex post would be after. So this is before the fact data, and what I'm presenting you here is a distribution of possible outcomes. There are only 3. And those are their chances. The normal state is more likely than a boom or a recession. And then these are the outcomes in pairs for the market variable and for the stock variable. These are their returns. Now, I've only given 3 states of the world. In fact, in finance, we use a distribution that is continuous, not a discrete one. But we don't do that in this course because I don't get to assume you know calculus, unfortunately. So this is a discrete distribution, and it's only 3 possibilities that have been summarized, and these are derived by looking at historical data, using models to predict future outcomes and the future state of the economy, using financial statements and reports to come up with expectations or perspectives of how this firm is going to do. So that's where that comes from. So we're not going to do anything like deriving this in this course, but you should be able to in the future if you proceed. With finance as a career, lots of this is just modeling, and there's software available to do this kind of thing. All right, so how is it done? How do I calculate the same variables but now this kind of data? The way that I do this is a weighted mean, weighted standard deviation, and a weighted covariance. all that's different here is I'm using Greek letters. Why? Because the Greek letters are reserved for population level parameters, right? So the parameter for the mean is mu, and that for the standard deviation is sigma, population standard deviation. So this is a weighted mean, weighted variance, and the weighted covariance. And now the weighted correlation is just a standardized covariance, and I have the two ways of representing that, similar to the one above. And finally I arrive here at my slope. The slope is known as the beta. It's also known as the beta up here, but if the data appear as ex ante, we actually use the Greek letter beta to represent it. Similar to the above, when you get used to it, this is R correlation, so this is R. Sigma for the x variable is sigma x, sigma for the y variable is sigma y. I should put this in here, this should be an x here. But you do the same for the y variable. And when you put it all together with risk y over x times the correlation, you get the slope. So I solved calculating all of these manually, and I gave you the solutions for this. And it turns out that also correlation is equal to +1 and beta is equal to 2. You can't see it, you can't visualize this as well, but that in fact is the case. So just to show you, you can't really visualize for ex ante data. You need to make the calculations. Now your calculator, if you have the BA2+, does not do weighted mean and weighted standard deviation and weighted correlation and the beta. It will not do those. But the HP10B2 does. And you can also do this in Excel. Okay, but you can't do this, you won't get these out of your BA2+. I don't know about the the Texas Instrument, the 80 or 83 or 84 that students use. Probably can do this in there with a third column, but I don't know. All right, so I spent another hour talking about this, but go back, and if you didn't understand what I just said, it means that you did not review the videos that I sent you completely. So I give you all the solutions for that, and then I summarize here. I rewrite those variables, but I use finance notation because that example or those formula that I gave you are the ones that you learn in statistics, right? But I'm going to translate those to finance where I'm talking about return. So now this is still a weighted mean, but I'm going to use R bar for the sample mean. I'm going to use R. So this is document 5.7. And I'm going to use this symbol as the estimated standard deviation for the returns. And to make it more complicated, then I'm going to talk about, each variable at a time. I'm going to use a subscript I. In this case, just verifying here. Right. So you're using I here to to represent the stock. And this is for the market. So this is always remembering that the market is always on the X. This is the X variable. This is the Y variable. And all I'm doing by reviewing these formulas to help you realize that they're all, you'll know these already. It's just I'm using different letters, okay, to represent returns. This is the deviation from the mean for the stock, and this is for the market return. So on the top where you have the data, notice I call this I and this M. So this is for the stock and this is for the market. But still, this will always be X and this will always be Y. Always being that the market will always be on the X-axis, as though we're saying that the market influences the return to stock to some degree. All right, then the different variations of the formula here. So I don't expect you to use this notation. I just present it because the notes and the text use different letters, but these are formula you already know. It's just using different letters to adapt it to finance. And then in the end, you end up with the beta, and the beta is written as, again, it's risk. R, which is the correlation, that now I'm going to use I and M. And I put the Y standard deviation at the top and then the X standard deviation on the bottom. So the vertical variable standard deviation here and the horizontal variable standard deviation here. And we notice that we can write this in a different way. If instead of writing correlation, I wrote the standardized covariance, and we could have done this earlier, but I'm going to do it here. So that's the same thing. I just wrote out the same thing. So this is the correlation, but I've expanded it from here. I should actually put the symbols here so you know this is also And what does this show? This shows lots of symbols that the slope is the unit of covariance for every unit of variance of the market. So it's giving you like a measure of trend, or for every unit of volatility in the market, it's giving you a measure of risk. Okay? So this is we just call it beta. We always call B beta, but now we actually have the symbol to go with it. The covariance standardized is the correlation one. So if you don't follow what I'm saying, go back and watch the statistics videos. Don't skip that stuff, because this is all going to sound like another language, like alien language. All right, so we have these two forms of beta. I could write it like this, and I could write it like this. And that is for ex post data, historical data. So this is the same as what I did before. I just put different symbols on it for finance purposes. And then here is for ex ante data. Again, I give you the same distribution, and I just rewrite the notation. Weighted returns, the weighted average, the weighted variance, or standard deviation, square root of the variance, the weighted covariance. And notice what I've done here is I've used different symbols, right? I'm going to use now just the Greek letters, not with the estimation symbol on it. This is actually mu. This is actually sigma. This is sigma. And that's because this is a distribution, not just a sample representing the population of data. Here's the correlation as a standardized covariance. These are the two ways of writing it. Actually, I only wrote it the one way. I didn't bother with the standard. It's just so complicated looking. I didn't bother putting the second variation on it. This is the form we'll use. And then the measure of slope, which is, again, risk. R, which is the correlation. SY, which is the standard deviation of the vertical variable, which is the industry stock. And the X, which is always the market. And the other variation of the variable, of the slope, is just for every unit of variance the market returns. What is the covariance? What is the influence on the covariance? So this is a measure of risk. All right, so that is why you need to do a review, because you need to feel comfortable with what I just discussed. So if you need to go back, right? So I'm going to start now, unless you have any questions, I'm going to start with the new material. So you should practice this. You should use Excel if you need to make these calculations. I gave you the solution sets, okay? And, oh no, I should already have it here. What's 5.8? Okay, so we're actually going to return to the UR case. And handle all this financial data now. And we're going to use it to improve upon the discount rate. We use a discount rate of 10% to evaluate the UR case. But we want to now include the information on financial returns to get a risk adjusted rate of return. So that is going to be the focus of the next few classes, how we do this. So prior to this, you learned how to determine cash flows for investment, for considering alternative investments or just evaluating an investment project. And I would give you the discount rate, but now what we're going to do is derive our own discount rate. And we're going to consider all the things that we need to do so. Yes, Juan. E is mean. Expected value. Okay, so if you don't know those formula, that's an indication that you go back and review, okay? Because all of this you should have learned in statistics. If you didn't take statistics, just review my stuff and you should be fine. So that means mean. I just wrote it here. This is the symbol for population mean. This is expected return. Variance of returns, standard deviation of returns. So please watch my videos. Don't assume. This is critical. I mean, the next week or so is going to be hinging on your understanding of statistics, okay? All right, so I'm going to move now to, well, I just talked about this. This is our goal then for Unit 5, is to answer these questions and come up with a risk-adjusted rate of return. Okay, so let's get to it. 5.9. That's not it. 5.9. 5.9 is here. Okay. So what we're going to talk about next are where those returns come from. I'm going to begin with, well, I think in this class I'm not going to show you how to derive ex-ante returns. I'm going to show you how to derive historic returns and leave the ex-ante stuff for future courses you might take. Okay. So when talking about stock returns, that's what I'm going to focus on. There's all kinds of returns, right? But we're going to focus on stock returns. What is the dollar return over a period? So the period is from t minus 1 to t, so last period to now. Let me do that again. It looks very messy. So over that period, if you hold stock in a company, for each share, you may get $1 dividend. You may not. Okay, so dividend are your share of profits or your share of the portion distributed to shareholders. The company might choose to reinvest some of its profits to your advantage, presumably. So so you could have $1 dividend, but then because of the speculation of stock in the stock market, there's a market price or market value available for your stock. And even if you don't sell the stock, that is considered to add value to the share that you hold, right? So the change in market value over that period is relevant to you. So that's a return to you. So this is the dollar return, the dollar dividend for each share, and the change in market value. So that could be a negative, okay? If speculators or the market perceives the firm as less valuable, the price may have gone down. This could be zero. There could be no dollar dividend. Okay? So those together make your dollar return, but we don't work with absolutes. We work with percentage returns. So how do we make that a percentage? What we do is we take the new value minus the old value. Well, let me just say this. We take the change we have to take this value and we have to scale it, make it relative to something. And what we do is we make it relative to the original price. And that gives us a percentage return. Okay, so we take the dollar return and we divide by the beginning market value. So that gives us the dollar return divided by the original market value. We could write that differently. We could write it like this. But more commonly we write it like this, so we can express this quantity represents the dividend yield, and this is the capital gains yield. So this is a measure or this is how you would calculate the percentage, the change in price. The delta symbol is usually used for change in economics, in financial economics, percentage change in price. So the percentage change in price is the new price minus the old price relative to the old or original price. Okay, so that's how you do percentage change calculations. So that's going to be called the capital gains yield. So what is this? This is the way go back. This is the way that we calculate either of these, which is one of them, right? So this would be the market return. This is for the stock. So the stock return was calculated this way by considering the dollar return divided by the price last period. So that's what we're figuring out. It's buffering. Hold on. All right. All right, next. All right, so even though this looks strange, maybe this looks strange, you've never seen this before, or you think you've never seen this before, we have used a variation of this in the past. Here is the formula written as the dividend yield and the capital gains yield. if I assume the return is the same every period, and I assume that the dollar dividend is the same every period. No, sorry. No. Not that it's the same every period, that it grows at a constant rate. And we assume that it does so indefinitely. The percentage change every period would be the same because it would just be G, the dividend growth grows at a constant rate. The first cash flow would be my dividend next period, and then it would grow at a constant rate, and the initial price would be PV0. So what I've done here is I've replaced each of these elements using those two assumptions. And now this looks familiar to you. If I rearrange this, so here I'm saying I want to calculate I. But if the return is the same every period, and we assume we know it, then I can rewrite this expression like this. Do you recognize this? Where the usual assumption is that the firm exists indefinitely. So what formula is this one? You recognize the formula? Let's take a 5-minute break so you guys can think about it and come back with some questions for me. I will see you in 5 minutes. Perfect. Perpetuity with growth. Good. So I gave you a little break to think about it, to respond. And there it is. So what does this mean? What did I just unravel? If you can make these sorts of assumptions, then with the goal of estimating the return, the appropriate risk-adjusted rate of return, we could do it this way. So let's say we knew all these things. Then the interest rate or the discount rate or the rate of return we should use can just be calculated like this. So even though I boxed this off, we already know that formula. This is our new formula, given, and we actually practiced with it before. If we make those assumptions, this could be our rate of return, assuming it's the same in every period. We can calculate it, assuming that we have constant growth. We know the price from last period, and we know the coming dividend. This is how we can estimate it. This is called the dividend growth model. So, provided you know those things and you make those assumptions, this is the easiest way, or this is an easy way to compute your appropriate risk-adjusted rate of return. And we need that, right? We need that to evaluate projects. Even if we use the internal rate of return, we still need to compare it to something. So this will be helpful in determining that value. All right, so that's the dividend growth model. What else? Okay, let's apply what we learned to this exercise. I'll give you a moment to try that and tell me the answers to those questions. All right, so you should be calculating using the formula. The return in any period is equal to the dividend. We can do it this way. The dividend yield, which is the dividend in T minus the original price plus the percentage change in the price or market value. So let's see, I'm going to do it in pieces. I'm going to first identify here, suppose a stock had an initial price. So that's going to be PT minus 1. And paid a dividend during the year. So this is the dividend T, and then this is the price T. Okay? So the dividend yield is going to be $0.84 divided by the original price, 42. Capital gains yield will be the new price minus the old price divided by the original price, which is 46.20 minus 42 divided by 42. So what do you get? Give me the pairs of results. So you get, yes, this is 2%, 10%, and this is 12%. Okay. Next. So you could have calculated the returns for a series, in a series type, like historically, just like we did before, period 1, 2, 3, and 4. And then you want to summarize what you had. So you would do this in every period over the time that you have data. And then take the values and come up with some sort of representation of the values. Maybe you're interested in how much, what was the return over the entire period. So you would say for each dollar invested, I would earn 1 plus R1 in the first period, 1 plus R2 in the second, all the way to 1 plus RT over the entire period, T periods. And then I would take off the principal, $1 invested. So for each dollar invested, this is with the holding period return, how much I made in interest, basically, in return. And for my investment. So that's one thing that might interest you. So this looks familiar, right? This looks like when we were talking about finding the effective rates. And that is what it is. The difference here is the return changes each period. Okay, it's not the same thing. Now, what if I want to know on average over that period, what was my return? Well, these have been multiplied to get this holding period return. So I can't just average them. I have to do the opposite of multiplication, and that's exponent. So this really looks like the effective rate calculations now. But remembering that these are all different, possibly different. And then -1. So this is called the geometric average return. So it's a measure of average for financial type data. It's useful. When we use growth, we consider factors of growth like this. This is the best way to summarize what happened on average. Different from the arithmetic average, just adding them up and dividing by how many there are. These will be the same if a distribution is symmetric. Or similar, I'll say similar. They're similar for symmetric data. When data are not symmetric, which one should you use? Do you know? Right, nice, Beth. You should use GAR. You should use a geometric. Very good. Okay. So what we're going to do here is look at that very notorious period where the stock market crashed. And these are data from the S&P 500 index. I actually give you a reference here because I got the data and calculated each of these measures myself. And you can see there's volatility. Here's the drop in the returns to investors in the stock market over 2008. Okay, so it's quite massive. And what we want to know is, over these 4 years, did we recover? Did the market recover? So we're going to first look at what an investor investing for every dollar starting in 2007 earned by 2010. So let's get the holding period return. Then we'll get a measure of the average return and we'll compare the two measures. So allow me to give you a moment to do that. Okay, the holding period rate, you got it? So we did not recover, right? Ended up with a negative if you did that correctly. Anyone else want to confirm that? Then you add 1 and take the fourth root and subtract off the principal to get the geometric average return. I think that gar's too big. But thank you for trying. Keep trying. It's more important that you practice to understand. I mean, some people can understand the formulas, but it's better to practice. So here are my results. So it's a negative. Very good. Here, a negative return for the holding period return. So if you invested $1, you lost 3.3 cents for every dollar. Okay. On average, spreading that out across the 4 years, it's about, it's 0.84% per year. So it's almost a cent per year. It's not a lot, but you didn't make anything. That's the point, right? You didn't make anything off your investment, and you tied it away here and into the market, and it was inaccessible. That's what we're presuming. We're presuming that we left an investment for 4 years and didn't remove it. And finally, the arithmetic average is 2.5. So you can really see how the arithmetic average doesn't adequately reflect the average. I'm not sure what you did with Gar Nisabeth, but your numbers are similar, but something went wrong. Just got to be careful with the negative. A negative 37 when you put it in here. You did it right here. I'm not sure what happened down here. And I don't know why you can't see. I don't know, I keep moving. I think I lost connectivity or something with the video. Hold on. I did. Okay, this will be better now. Somehow I lost a connection. There you go. I don't know, I think it broke again. I don't know what's going on. What's going on? Okay, it should be there. You see things? Oh my goodness, it keeps freezing. I'm not sure what's happening. I don't know why you're seeing that view. It's not happened before like that so many times. And this is like frozen. Very confusing. I think, okay, there we go. All right. So, I mean, if you're looking at the notes, you would have seen this anyway, but so you see that the average, geometric average, is different from the arithmetic average. This has been affected just by the nature of these values. Anyway, it's not representative, not like the GAR is. Okay, so when they're different, go with the GAR, geometric average return. All right, so this shows us over the period, we didn't make anything. We actually lost 3 cents on every dollar. And then on average, each year, we lost about a cent, or 0.84 of a cent. Okay, questions? So we started with this data set where I gave you the return. So we didn't have to calculate these. I gave them to you. And then I asked you to use them to summarize this time period. And you did that by getting the holding period return, a measure of the average return of the return per year, and we think this is more meaningful than this one. That makes it look like a positive return each year, which is just not the case. All right, so return is a measure of reward, right? If it's positive, it's a positive reward. If it's negative, it's a loss. But it doesn't tell the whole story. Volatility measured by the standard deviation or the variance contributes to our understanding of what to expect and the risk inherent in that variable. So what I have here are actually 3 asset classes. Well, actually there are 2 broadly. I have this risky assets represented by the market index S&P 500 plotted here. And that's the most volatile. So on average, even though it looks pretty flat, on average over this period of time, you're going to see it's a positive return on average, even though it's so volatile. And we're going to calculate it, or I'm going to show you the results of calculating it. The less volatile would be bonds that are more secured because investors in bonds have a promise or a commitment for a return, right, from as a result of buying bonds in a, here are the treasury bonds, so these are bonds, loans to the government on a 10-year basis. The returns are much lower. You see, it's just this line that's a little more volatile than, but not as volatile, except for in this period, as the stock market. So it's less volatile because there's less risk associated with a return. There's guarantee. Creditors can actually take, well, in this case, the government can guarantee returns to treasury bills because they can raise taxes to pay them to the creditor. So this is less risky. There is higher return, though, in times of a contraction to incentivize investing. Higher return is offered, you see. And the years, what happened to my years on this graph? Oh, yeah, they're up here. All right. So they're a little bit higher. And then the lowest volatility is associated with the lower risk returns. In this case, it's the 3-month T-bill that I have plotted here. So that's another part of the story that needs to be told when you look at data. I've plotted to 2016. And so let's calculate the variance using the small data set I gave you over the period 2000 and just around here. Okay, so I want to calculate now for the stock returns, this big dip. What's the average in this period is what we calculated. What about the variance? What's the variance? So we just talked about getting the variance. You can actually get it out of your calculator, but manually it would look like this. And I perform these calculations in columns from here on out. And I did it also, you notice in the review videos for statistics, I do things in columns, just like Excel uses columns. It's easier to transcribe the data. Here's the return. And notice I use here, even though we agreed that GAR was better, I just want to do the exercise, complete the exercise of calculating the variance for this data. All right. And I'll explain why in a bit. I just want to practice this. So this is what you would get. This is the variance, and then you have to take the square root. Notice there's a square here, right, for variance. And then you need to take the square root to get the standard deviation, which is 27.69. That's quite a bit. So if you use this data with the arithmetic average here, that's what you would get. You could put this data into your calculator. You could use Excel. The point is, whatever you do, you should be able to calculate the variance and then standard deviation. So try this yourself. Okay? Questions about calculating that? You could have put it in your calculator. So we're going to go back to the data and clear, second clear worksheet, and start entering just the one variable. I'm going to put 5.49, enter down, down, and then 37 negative, enter down, down, and then 26.46, oops, that's not right, 26.46, enter down, down, and 1506. And then ask for the results. Hopefully I entered everything correct. And I want the standard deviation 27.69. You see? Yeah, good. So you can enter them as whole numbers, right, into this calculator. So I really want this to be efficient. I want you to feel comfortable using the calculator. All the manual calculations are to help you understand the formula, which you also need to understand. But in the end, when writing tests and performing tasks, the calculator is just fine. There you go. And now remember, I'm using these symbols because it's historic data. I have to use the estimation hat symbol because these are just statistics. They're not parameters. All right, so then I did it again here, step by step. You should practice, make sure you can make those calculations. And now what are we going to do? So what we're going to do next is the interpretation part. So we have a mean and a standard deviation. As I explained in the videos, if we assume distribution is symmetric, then we can use the idea of x plus or minus, standard deviations from the mean to understand its behavior. X bar plus or minus 2 standard deviation, x bar plus or minus 3 standard deviations to help you understand what to expect. It turns out that the returns to the S&P 500 are over long, with lots of data. We only have 4 data points here, but with lots of data, and I've taken the returns from 1928 to 2016 and calculated the average for you, and I'm going to treat it like it's a parameter because I used a long period of time, and I believe this is the behavior. So and I believe this is all the data I'm interested in. So I'm going to call this mu, 11.4%, and the standard deviation turns out to be 19.7 over this long period of time. And as I explained, market returns are assumed to be normally distributed because that's the behavior that's been seen, that's symmetric and roughly normally distributed. So what I want you to do in the space here, or on a piece of paper, is depict the normal distribution with this mean and this standard deviation and answer the questions below. So I'm going to give you 5 minutes to do that. Well, I think 10 minutes. So take 10 minutes to do this for me. You can ask me questions. I'll sit here and look at your questions. I just think it's a couple of us here. People busy, have things to do. I guess it's Halloween weekend. But anyway, I'll proceed. Presuming people will review this later. They better. I don't know how they're going to do this otherwise. But okay. You're going to draw this. You draw it. As a normal distribution. And that's my roughly normal distribution, and I plot I'm in the middle. I have 11.4%. And then one standard deviation away. And I have to plot those roughly one standard deviation away. Brings me to $31.1 in that direction. A negative 8.3 in that direction. And then going over a little bit more, that's 2 standard deviations, and then 3 here. There you go. So what's the answer to the question, what is the chance of positive returns? What do you say? Approximately. Now you could do this with Excel and get the exact value, but just approximately, what would you get? What would you think? Where do the positive values begin? So I could, looking at the drawing here, the 0 You know, this is between here, 0 is somewhere in here, and I want to know how much bigger what's the chance of being a positive? So I want to know the probability of being in this area. So it's going to be somewhere between 50%, which would have been here, and how much would it be here? This much, this portion adds how much? Just between here and here. So it's supposed to be 68% of the observations are between here and here. Not sure which number I should. Okay, I'll just use black. So between here and here, 68%. So between here and here is 34%. So what do you think? 50 plus 50 plus, I don't know, 16. What's 34 divided by 2? This is a real approximation, right? Let's see. So 17, right? So 17 plus 50. It's more like 67, but thank you for the guess, Miss Sale. So we'll say about approximately 65. We'll just round it, something like that. But now let's check. Let's use Excel and check. So what I did here is I asked the question, what's the probability that the variable is greater than 0 or positive? Then I standardized it with the mean and standard deviation, and I can look this up in Excel. Now Excel gives you the left side. So we'll have to account for that. So the number is negative 0.57868. Let's go to Excel. I was making another calculation here. All right, so what you do is you want to use the standard normal. So you use an equal sign and you put normal distribution, but you want the standard normal. So you have to put dot S. I don't know if you've ever used this before, but it's very useful. So then you put the value, and in our case, it's a negative 0.57868, and then a 1. Now this is going to give us the left side. The 1 is that you want it cumulative. So that's going to be the left side, 28. So we have to make equals. So let me put the formula up for you, for people who are interested. thing gives me trouble. I'm not used to using it on my iPad, but I want to go over. So what I'm going to do here is so you can see this notation. There you go. So that's what I wrote, starting at the equals to get that result. Okay, and now I want to calculate 1 minus that. So 71.85. So it's more like 72%. So I said 65. It's more like 72%. So let me put the formula for that. Are you learning something? Something new? What happened just now? Oh, that didn't work. I'm just going to write 1 minus. I don't have to have that many decimal places. I'm just putting it. Okay, so 72%. Much higher than our approximation, so anyway. So the chance of positive returns is 72% of the values, right? So of the possible observations, assuming normality in the distribution, we estimate is a high chance of a positive return, 72%. But just doing it with this graph is like some 65. Okay, what is the chance that returns will be less than negative 30, approximately? What would you say? So again, if you don't know what I'm talking about, go back and do the review. Maybe that's where some people went. They went to do the stats review before they watched this video, which is great. All right, so negative 30 is around, it looks like it's over here somewhere. So what's the chance of being over here? It's close to negative 28. And at negative 28, we're beyond 2 standard deviations away. So what's the chance of being beyond 2 standard deviations? Well, 2 standard deviations means is a little bit off. Let's do that again. Oh, cheat. So that's 95%, right? So if it's 95% between, then it's 5% outside. So this is going to be 2.5%. So it's about 2.5% chance. It's small. I'm only 2 away, not 3. Miss Sale. Okay, so that is an application of statistics using the most important things for us that we learn from statistics. We can make some guesses of what to expect. Okay, questions? It's okay, at least you're still here. All right, let's see what's next. So here we have some historical statistics. This was from a textbook or some. So this is older data, but you'll see this. The pattern is similar for us going to 2016. So up until this point where the global financial market crisis occurred, this is what you see. In this asset class of large company stock, the return was 11.77%. So it's similar to ours was 11.4. Including it up to 2016, we had 11.4. So before the stock market, so it did affect the average, didn't it? The overall average. It went down a bit, but it's still about 11.5 to 12% returns on average. So I'm allowed to do the arithmetic mean, right, for this, for the index of returns over a long period of time, not a short period. And so we also could calculate the standard deviation. And you see here a histogram. So it's quite volatile. For small company stocks, notice the pattern that the return is higher on average, but it's much more volatile. It's much more spread out. So much more risky. All right? For long-term bonds, more of a guarantee, less risky return, but accompanied by lower return on average. Similarly, long-term government bonds. And here's the U.S. Treasury bill. So on average, the U.S. Treasury bill over this period was about 3.8 with some volatility, some change. Now this is this is just telling you, if you look at this, if you think about Treasury bills, outside of one standard deviation from the mean, you could have negative, looks like there'd be negative returns, right? Now Treasury bills are very tight distribution, so you're not really, anyway, here I use this scale, and you could see that after one standard deviation, you're in the negatives for Treasury bill returns. So what you want to do as a prospective investor, and this is what we're going to talk about now in the theory, prospective investors are aware of inflation, and they want to keep a hedge against inflation. So to beat inflation, this is prices rising on average over time, and it looks like it was 3% every year on average. So that means some years it was more, some years it was less. You should hold Treasury bills, because Treasury bills will retain the purchasing power of money. It'll be a hedge against the inflation. So that's the message there. Now what else do we get out of this chart? So we're going to compare, since investors should hold the Treasury bill because it beats inflation. What should incentivize them to invest in something more risky? Well, they're going to have to be compensated to take on additional risk, and that's how we interpret the higher return in these asset classes. All right, so we have a name for that little bit of extra return. We call it the risk premium. And the risk premium is calculated by taking the return to any specific asset minus the return on T-bills. So we're going to refer to T-bill returns as risk-free. Even though there's volatility, it's a guaranteed return. We refer to it as risk-free. So for each asset class, calculate the risk premium in this column here. Included in the chat. Okay, so you're going through and subtracting the return, average return. I should put a bar here because this is the average return. But I guess these are average returns, so I should put a bar here too, but later I'm going to take that away. Okay, so that's a bar because it's the arithmetic average return. Okay, good. I got the same numbers. So that is the risk premium. And here I have the data all to 2016. I made this myself. Okay, so I updated the data set and I got you some histograms here. And the number's similar with a risk premium of 7.9 for the risky assets in the S&P 500. Standard deviation 19.7. So it's very similar to what large company stocks here. Okay, so this is the S&P. And government bonds in general, risk premium 1.7, and treasury bills here over this period. It's a little bit higher. No, it's about the same. All right, so over a large period of time, the pattern stays relatively the same, the mean and standard deviation relatively the same, and you can assume normality in stocks. You notice in the other asset classes, not so, nor this is actually completely skewed here. But anyway, this is where we work with the risky assets. So that is that. Let's get to the next set of notes. Okay, I'm going to pick that up. So this is 5.7. So what I do is I give you some exercises that you should practice. You already have them. So that's 5.8, 5.9, 5.10. So this is a review. So practice making all these calculations. And let me know if you have any questions next class. I'll work on these problems with you. So it's all about calculating returns, working with return data. And now 5.11, I think, is the solution set. So 5.12 will be the new data. the new notes. And here are the lectures. So we've talked about risk and return, and we've noted the relationship and calculated a measure of the risk premium that demonstrates the little bit more, the premium that investors would require to take on the risk associated with the asset class over and above treasury bills. So now we're going to talk about CAPM. Now you've probably learned CAPM before, you should have, but I'm going to go a little bit deeper with our calculations and our understanding. Remembering to make good or value maximizing financial decisions, one must understand the relationship between risk and return. We accept the notion that investors like return but dislike risk. Okay, so that's how we're going to proceed, although we will mention risk, we'll refer to those as risk-averse investors, but we'll differentiate between them and risk-loving investors. Consider the following proxies for return and risk. We used for return the average return, but in this case I'm going to now go to the ex-ante data distributions, where I give you a distribution and we work with the parameters. Okay, so we're going to look at expected return as a weighted average of the distribution of the possible returns in the future, and we're going to calculate the variance as the measure of risk, and the variance of returns will be also a weighted variance. But I could do this, I could just as well do this with ex post data, but I'm going to practice doing it with ex ante data now. So this looks hopefully familiar to you. Here are my 3 states of the world. Here are my possible returns, and this is for stock in a company XYZ. So to calculate the expected return, we have to get a weighted average. To get the variance, we have to get the weighted variance and square root to get the weighted standard deviation. So you can do this in tables. Now at this point, I am assuming you conducted the review, and you can do this quite easily using Excel. You make a column for probabilities, a column for the returns, and you multiply across the columns. I'll do it for you to say I did it. All right, so let's do Excel. Back to Excel. So here I'm going to put the probabilities. Where'd my keyboard go? Excel acts weird and unexpected. Yeah, doesn't want to open. So I'm going to put probability here, and then I like that little keypad. I don't know how to get that back. Okay, so the probabilities are 0.25, 0.5, and 0.25. And the outcomes, the returns, are 5% negative, 15%, and 35%. And I can leave them like this. As long as I remember their percentages, should be fine. So now what I want to do is multiply probability times return. And I want to copy that all the way down. I haven't figured out how to use this on my iPad yet. And so I sum those. Let me make a note that this is probability times return. And the sum is the weighted average. Oops, what happened here? That's not what I wanted. That's better. Okay, so that's what you're staring at in the notes. Oh, you don't have 512? Really? Are you sure? Let me send it to you. Give me a minute. I've been talking to myself for a while here. Anyway, have a look at that. I'm going to put up my notes. So I'm going to send you everything that remains in Unit 5. Okay, get yourself organized. I sent them. Okay, when you're ready, let me know. I'm going to go another 10 minutes. So for me, this is review. I mean, for you, this is review. And from my perspective, because you should have learned this in 3106, but it might look a little different the way I'm doing it, or a little more difficult or challenging. So it's just a matter of review on your part. Synthesize what you learned before with what we're doing now. Got it? Document 12. All right, so that's what I did in Excel. What about the standard deviation? How do I calculate the standard deviation of this data? This was the mean. The sum is the mean. For the standard deviation, we have to get the deviations from the mean. Which is going to be I should put a formula in there. So this is what we have to do. We have to calculate the return minus the mean of returns. So we're going to calculate It's going to be 13i, so let me put that in. What did I do wrong? That's not a minus. There's a problem with this one. I'm not trying to type a formula. What is going on? I don't know why it's so different. It's on the iPad. It shouldn't be. I'm just going to put 15. Forget about this. But is even the minus going to work? Okay, the minus. This is not minus. This is minus? No, that's not minus. 15, is this gonna work? It worked, okay. So that's the deviation from the mean, and then I wanna copy that all the way down. So 15 is no different from the mean, so the deviation is 0. And then 35 is 20 more than the mean. So that's the deviation from the mean. So the deviation from the mean squared then you square it all the way down and you sum, and what do you get? Oh no, that's not what we do. We have to multiply it by probability. Trying to make it look the same. Okay, so that's what we have to do. We have to multiply probability. So I have to take this column over here and multiply it by this column over here, and then sum. Oh, and I forgot something. I have to square that, don't I? That's what I have to do. I have to square this. So this should be familiar to you. I should be able to take the probability times the deviation from the mean squared, and then copy that and that's that, and then sum to get the variance. So you can see why I don't do this. You need to do this. This is I'm only going to do this now, but after this I'm assuming the knowledge. So then this is equal to the sum of those amounts. So you can prepare a spreadsheet to help you calculate these more easily. That's the variance and the square root of the variance. So if I didn't do anything wrong, did I make any mistakes? And we'll talk about the notation in a second. Yeah. The issue is with the variance, it's not nice. It doesn't show up nicely in whole numbers. It's a little convoluted. I actually have to make these decimals when I do this to show the variance. But when I take the standard deviation, I think I fix it. Because the standard deviation is 14%. Did I do something wrong? They have 2. It's because I didn't use decimal places. I can just fix this very easily and put the decimal places in, and everything should adjust. It's not exactly wrong, it's just hard to interpret the variance unless I have the decimal places. I learned that a while ago. Okay. Oh, what happened? Oh, because I have to change this one. I have to change these to 15%, or it doesn't work. You want to copy the formula all the way down. Finally, there we go. So there's my variance. So the difference was that I used the returns without the decimals, and then the variance is not interpretable. Remember, the variance is the square, and if I don't use the decimal places, I have too many decimal places on this result. But when I take the square root for the standard deviation, it would have been correct, but I just wanted to align it with what you have in your notes. My goodness, why is this so unstable? Like, where'd my keyboard go? Anyway, you need to take the square root to get the standard deviation. I'm not going to waste more time on that. All right, so then this was our variance, you see? And don't be distracted by all the symbols. I just put it in words in the exercise. It's return minus the mean of the returns. And then here you square the deviation from the mean, and then you multiply to get the weighted variance, and then square root to get the standard deviation. So this is it, 14.14. So this should be second nature by now, all right? So if it's not, go back and review the statistics material and rehearse this calculation. Remember, I'm using the notation for finance with the R's for return. But the statistics, the mathematics of the calculation are the same. All right, it's 12 o'clock. I want you to work on the exercises for review. Make sure you have a great understanding of statistics, not an adequate understanding, a great understanding of statistics in terms of what I've already given you. And as review. And then we're going to start here next class. We're going to look at portfolio, because we don't just look at returns in isolation, we imagine combining them into a portfolio. So combining stock and the returns into a portfolio and seeing what we get. So we're going to talk about that, and we're going to talk about portfolio theory, and I don't know, maybe next class we'll finish Unit 5. All right, so get going on Unit 5, and I must get you your grades this weekend because I have to submit them. So you will get those grades this weekend, and I apologize, the grades for the tests. I just imagine, you know, I'm just as busy. I don't know. I can't compare my business to your business, but I have a lot going on. And I said I would only mark a few questions of the test, but still it takes a long time to do it adequately. But you'll have the grades this weekend. You have to. So other than that, have a good weekend and a good week, and keep me posted about your progress, all right? Let me know if you want to meet with me at any time in the week for office hours. We can do it virtual or we can do it in person. Okay. So keep me posted. Have a good week. Bye for now.